Good day, my friends and loyal viewers. Let me begin this segment with a question. How often have you run into an older homeowner that was interested in a reverse mortgage, albeit a HECM or maybe even a jumbo reverse, but they were looking to qualify for Medicaid, or perhaps they were already in the program? And have you walked away from such deals, or did you just feel like I've got to stay away? That's going to be a real problem. Well, this segment really points to the importance of working with elder law attorneys when you do encounter such a homeowner. And there are some surprising ways that you can still keep your Medicaid benefits, I should say the homeowner's Medicaid benefits, even with a HECM if it's structured properly. So let's dive into a recent post I found on an elder law blog. Attorney Halley C. Allaire of Allaire Elder Law notes that reverse mortgages can be a powerful tool for seniors who wish to stay in their home and pay for care or even retain their Medicaid benefits, but only if they're structured and managed carefully. Of course, a reverse mortgage allows a homeowner 62 and older access to home equity, but how those funds are used does matter. He notes the key to Medicaid planning is that the funds that you do receive from a reverse are not automatically treated as income by Medicaid, and that is a very important distinction. It's how much funds come into an account and how long they stay there. Allaire notes as long as those funds do not sit in a bank account and pile up, they generally do not count against the strict asset limits that do determine Medicaid eligibility, or even if a homeowner may lose it or increase their share of cost. That is not something you want to see when it comes to Medicaid. So in his blog, Allaire looks at 3 ways that you can, in fact, use a reverse mortgage, and it seems that he's referring to a HECM and still retain your benefits. And the first is how you receive those funds and how long they sit there. Medicaid rules in most states require that loan proceeds be spent in the month they're received. Otherwise, those unspent funds may be counted as an asset, a countable asset, that could put the homeowner's Medicaid coverage or benefits at risk. That is, if they exceed the threshold. Second, there's the question of how the HECM loan is structured. That is, how those proceeds are being received. If you're planning to apply for Medicaid or you're already on Medicaid, your elder law attorney, he writes, or financial advisor can help time the reverse mortgage distributions so the proceeds don't jeopardize eligibility and help the homeowner track expenses so those funds are used in a Medicaid-friendly way. The bottom line, it appears that reverse mortgage proceeds do not always have to pose a threat to Medicaid benefits, not Medicare, but Medicaid and needs-based program if they are structured properly. I've included a link to the full column in the show notes for your review. Ladies and gentlemen, this next story really speaks to an initiative that's been discussed much in our industry, but we haven't seen executed in such a detailed and effective way. This story really caught my attention, and it is a new certification partnership between Fairway Mortgage and NAIFA. That is the National Association of Insurance and Financial Advisors, a great group. And so with us today, we've got the brain trust that's been working on this. So we want to welcome you here at HECMWorld and Reverse Focus. Please briefly introduce yourself to our audience.
Thank you, Shannon. My name is Dan Ventura. I'm the president of reverse lending over at Fairway Home Mortgage.
Hey, Shannon. My name is George Bain. I'm the vice president of reverse lending initiatives at Fairway Mortgage.
Hello, and I'm Gabrielle Gregeline, and I am a home equity specialist at Fairway.
Thank you all for joining us today. So I have some questions because there's a lot, I think, in the background that can be missed in this story. But first is, the financial community has really treated the home as a last resort asset, if they even consider it at all in retirement planning. So from your perspective there at Fairway Mortgage, what have you seen, what sort of changes are you seeing evolve in that perception in the financial community?
Well, our industry, we do a really good job of letting everybody know how many thousands of people each day are turning 62 and how many trillions of dollars that seniors have trapped in home equity. But what we need to do is we need to move the needle. And by doing that, the way is by educating the financial community and offering and coming at it with a holistic approach of incorporating home equity into the overall plan, not just as a standalone decision. And that's where we're really hoping to educate and inform and, let everybody know what the program is.
Just to add a little bit to that, this program is designed to educate. It's not a program designed for origination purposes. It's designed to educate financial planners on the importance of home equity.
So it was very specifically pointed out that the intention of this certification is not to turn financial professionals into reverse mortgage salespeople. Can you speak to that a little bit more?
Yeah, George, you want to take that one?
Sure. Well, like I said, the program is designed to educate. It's we don't want these reverse mortgage planners becoming financial advisors, and we don't want financial planners becoming reverse mortgage specialists. We are simply here to show the compatibility of the two disciplines. In the holistic approach that Dan mentioned earlier, in order to be a holistic financial planner, you have to look at the whole. And the simple truth of the matter is home equity is part of that whole plan. I mean, it is such an important aspect of retirement planning, and it's been ignored for way too long. So it's not a fault of the financial planners. It's a fault of the fact that it used to be a questionable product with, unfortunately, some predatory lending back in the past. Tons of regulation have come out and changed it, and it's now probably one of the best programs there is out there for senior Americans. And we have to get that out in front of people so that they understand it.
To piggyback off of what George said, and what we're doing is we're just looking, like George said, to educate the financial advisors, and again with the holistic approach, but ask the questions like, why isn't home equity part of the conversation with every senior or every client that's approaching retirement age? And our whole goal is just to open everyone's eyes to see what the program is and how it could benefit, and why aren't we using that why isn't it part of every conversation in retirement?
Can I add to that too, Shannon? I think, habitually, like George mentions, home equity was excluded from part of the conversation because of the bad reputation around a reverse mortgage, and because of the lack of any other alternative to access home equity without creating a payment. Right. So you think of using a HELOC or cash out refi. If somebody wanted to get in their home equity, they were going to have a payment too. And reverse mortgages were off the table. So we're out there just trying to get the education out that, the regulatory changes have been made. It now has a valid, it's a valid part of the financial discussion, and habits need to change, and it needs to be reintroduced and talked about.
That segues into my next question, which is, how does the CHEA, or Certified Home Equity Advisor designation, kind of dispel some of those perceptions of housing wealth that have been held so tightly in the financial planning community?
Yeah, that's the beauty of this, is that by offering the CE and explaining to the advisors exactly what they can do with their clients in their retirement, with all of these options that they maybe previously had never even looked at because of limitations or reputation of the product. What we're doing here is that we're explaining everything, and how utilizing home equity in retirement is really a great way to just bolster somebody's retirement, secure it, and offer the benefits and options to their clients while keeping more assets under management.
So with financial advisors, and even insurance professionals, obviously there's a fiduciary duty. How does the CHEA certification address that, or does it?
Yeah, we definitely address the perceived problems, I guess, with compliance and what have you. We definitely address those very well. Keep in mind that NAIFA the organization is 18,000 members. And this program has to go through some rigorous compliance tests, and in order to be a CE accredited, it had to go through the CFPB and is approved for CE credits for CFPs. On every state that we teach the class, we have to go through the insurance commissioner. So the slide deck and the program, the curriculum is approved by them. So there are certainly a lot of quality control and regulations to make sure that this program is designed simply to instruct.
My last question, then any comments from you all, is how do you ideally see this certification working in, real reverse mortgage lending, right, in the real world? How do you envision this certification kind of creating this bridge once an advisor, insurance or financial advisor has been certified?
I think it's all about again, educating and regularly connecting with the advisors to let them know the benefits that they could be leaving on the table for their clients. And actually, the whole goal is to have each of the advisors just really take a look at home equity early on in the early on in the relationship with the retiree, and not miss out on anything, and just make it part of the initial conversation. That would be ideal. We've got a long road to go to get there, but I really feel that this program with NAIFA, and like you said earlier, Shannon, the buy-in of NAIFA to understand the importance of home equity in retirement is huge. And incoming President-elect John Wheeler is a huge fan of reverse and utilizing home equity. So these are the little things that we're getting momentum and building on, and it's a matter of educating and offering the continuing education, and just keep the conversation going.
A bonus question now for you all. How does the reverse mortgage professional, the originator, utilize this? It's not just a one and done, obviously. They get their certification. What sort of follow-up and engagement is down the road with that financial professional, on behalf of the reverse mortgage originator?
Well, we actually just met on that, and we've had many series of meetings on this. We've got our first class coming out in a few weeks in March, and it's all about the educator or the instructor is not the salesperson, right? You can't have the teacher calling the attendees and trying to sit down and have coffee and meet with them. But with our platform here at Fairway, if you want to work with the NAIFA advisors, they have to join NAIFA and become a member and actively work with their local chapters and their local advisors. So it's just opening up this huge opportunity for our loan officers to begin those conversations by going in and offering the continuing ed.
Shannon, can I add to that just a little bit here? This program also covers all forms of home equity. We have part of the program is cash out refinances. Part of the program is whether or not you should sell your house or whether or not you should take a HELOC. We discuss all aspects of home equity, and in doing so, we also create a trust factor between the loan officer and the financial planner, so that we can start introducing people to financial planners at a much younger age, in their 30s, first-time home buyers, all of these people that need financial planners for the long term. What is it? 80% of people don't have financial planners, and 100% of people should. So this program, as we introduce our loan officers to financial planners, we want to introduce their other clients to them so that they can help them prepare for the future, even if they're young at started. It's not simply a reverse mortgage product that we're trying to educate financial planners on. We're trying to put home ownership, financial planning under the same umbrella.
Well said, more of a holistic approach. Well, Dan, Gabrielle, and George, thank you so much for spending some time with us today. And we'll include a link to your certification page on the show notes. So we look forward to hearing more in the future.
Thank
you. Thank you for having us.
Cheers. When you look at the latest data, it's a stark picture when it comes to Americans' retirement preparedness. This according to a recent post from the National Association of REALTORS, or NAR, and just how little have, younger American workers saved. NAR reports that the average American worker between the ages of 21 to 64 has less than $1,000 saved for retirement. That's right, 30-some years from retirement, and many households have barely sketched out any traditional savings plan for retirement. And even amongst employees who are working with a employer-sponsored savings plan, the median balance is only $40,000, which is far short from the recommended amount of savings that one does need to retire. However, to be fair, I must note that the Federal Reserve Survey of Consumer Finances shows a higher number, which is good. Their findings note that households between the ages of 55 and 64 is about $185,000. That's the median amount. And that's much higher than the average savings amount or even the median savings amount for the younger cohort that NAR is noting. And here's the good news. Research from the National Association of REALTORS shows that homeowners in their 60s generally have owned their home for more than 2 decades, and during that time, price appreciation can translate into hundreds of thousands of dollars in housing wealth, on average over $200,000. Can you believe that? That's one of the benefits of the artificial run-up in home prices after the pandemic. Nadia Evangelou, principal economist and director of real estate research at NAR, says that for many middle-class households, home equity has become a major source of financial security as they transition into retirement. In other words, where traditional retirement savings are falling short, home equity is often backstopping that shortfall. Of course, there are trade-offs when tapping into home equity. For the older homeowner, you have accrued interest in a reverse mortgage as the home is at least appreciating modestly, so that is somewhat mitigated by home appreciation, but you do have a growing loan balance. But there are also trade-offs when it comes to selling the home and downsizing, a topic we covered in last week's episode, because you have the realtor cost, and then you also have the trade-off of leaving a home that you are familiar with and familiar surroundings as well. Steve Irwin, the president of the National Reverse Mortgage Lenders Association, said, at a time when inflation pressures and the fear of outliving one's retirement savings remain top concern for retirees, home equity stands out as a powerful yet often underutilized financial resource. When incorporated responsibly into a broader retirement strategy, this wealth can help seniors offset rising costs, reduce income shortfalls, and gain greater peace of mind about their long-term financial security. So the bad news is that many Americans, especially the younger cohort of workers, are ill-prepared for retirement, and even older workers are far short of what they need. But the good news is that home equity and you, as a reverse mortgage professional, may perhaps be able to help them bridge that gap.